Hey guys, welcome back to Ostrich Investing. Today we're going to talk about SmartCentres REIT. It currently offers an 8% dividend yield, distribution yield. Is it safe? Let's jump into it. So if you're new to the channel, Ostrich Investing is all about investing in the stock market, surprise, surprise. And we talk a lot about individual stocks. So if you like the video, like the content, please subscribe. Over on the right, you can see 2020 was awesome for the channel. We were up 500% in subscribers. So I'm going to compare that to Tesla stock. We're basically the Tesla stock of YouTube channels. We'll go with that. So SmartCentres, it's a Canadian REIT with retail property focus. Walmart is the anchor in most of its properties. And it's also got a lot of development activities, which we'll talk about. Topics that are going to be included in the video are Mitch Goldar, who's the executive chairman, his ownership and the structure, which is a little bit complicated. Number two, talk about the Walmart concentration is a significant portion of their revenues. Three, we talked about it before, the distribution safety, currently 8% yield, development activities, and then of course key considerations for investors. Disclosure, Ostrich and the Penguin are not currently in a relationship. I do think the stock or the REIT is interesting, but don't currently own it. Okay, so the business, the company has a pretty good investor presentation, which I recommend you take a look at on the website. They don't really have a great map slide outlining their portfolio, but as per them, they've got the best portfolio in the country. They've got 166 properties. What I really like here, and we'll talk about a little bit, is they've got 3,500 acres of land. And as they mention here, less than 24% of that is utilized. So 2,775 unbuilt acres. So think parking lots, those big open parking lots in those retail strip malls. Most of or many of their properties are located at major intersections, transit connectivity. 60% of their portfolio is in Ontario, FYI. You can see the tenant base below here and some pretty high quality names. And they say 50% plus of rent is coming from creditworthy and open essential service tenants. And of course, we'll talk about Walmart, which is their largest tenant. Occupancy currently 97%, so very strong. And then the other key thing here is the company has 256 development projects that they're working on at various stages. And so they've got more development projects than they do properties. So 166 retail properties and 94 properties have development projects on them. So several properties have multiple projects. How's the stock done? Well, rock bottom. 2020, no surprise for a retail REIT, was tough for SmartCentres. It hasn't really recovered from the COVID crash, and 8% yield at current levels. The distribution has not yet been cut. So unlike Riocan, which we talked about recently, SmartCentres has not cut their distribution. One thing I'll point out here, and credit management team, back in 2019, they did a $230 million bought deal equity raise at a little over $31 a unit. So if you think about capital allocation and obviously that equity raise looks really good now in terms of timing and ability to delever a little bit and just strengthen the balance sheet. Obviously the timing very good there. And then in Q3, November 2020, just off on the, there we go, there's my mouse. Just on the right-hand side of the chart, you can see a little spike in the units. They released Q3 results that were fairly strong, and the development activities that we're going to talk about actually contributed to growth in their funds from operations in Q3. So some of those more lumpier, potentially one-time in nature profits from condominium sales really improved the bottom line for the company. And then here, just for fun, I did a side-by-side with SmartCentres and Riocan. It's kind of been about the same story here over the last 5 years. Misery loves company. They're both down about 5% over the last 5 years. Okay, on the financials side, they don't have a great table in their annual report that goes back 3, 4, 5 years, so we won't spend much time here other than to say revenue of about $800 million, and FFO has been more or less stable. A little bit of growth here. You can see FFO, and they've got lots of different adjustments for one-time items, transactional FFO, yield maintenance costs, which is sort of prepayment penalties to pay down debt earlier and bring in new debt at a lower interest rate or yield. Okay, 2020. There's a lot of numbers on the screen here, but don't worry, we're gonna sift through them. Really, just one big point that I want to make here, which is if you look at just NOI on a year-to-date basis here, you can see $382 million in proportionate share NOI for the 9 months ended September 30th, 2020. Compare that to the same period in 2019, and it's about the same, it's about flat. It kind of masks a bit of the story. And the big difference here is if you look up at net rental income and other, it's actually down about 10% year to date. It's gone from 383 million down to 351. But below here, that's buffered by the net profit on condominium sales. Again, these development activities that are starting to bear fruit, which has provided 31 million plus increase in NOI. They've categorized this as part of their NOI. So development profits have supported cash flow in a tough year. Okay, now we're going to talk a little bit about the structure. And Mitch Goldar, who is the executive chairman, there's a couple slides on him in the history in the company's investor presentation. But Mitch helped bring Walmart to Canada dating back to 1989. So he's been in the business for a long time. Callaway REIT, some of you may remember that, merged with SmartCentres back in 2015. And so that was him vending in his development company into the REIT. And it came with all of the employees. I think there was about 200 of them, except for Mitch. So he sold, everything kind of went in. He has a 21% ownership stake in SmartCentres, but he kept himself outside, and a company called Penguin remains outside. So that's his vehicle. So it's interesting that he vended everything in except him and this one vehicle. So there isn't perfect alignment here. Obviously, he owns 21% of the units. So he cares and wants to see it succeed. But as we'll talk about in the next few slides, there's some related party transactions here that if you were to invest in the company, you just want to make sure you're comfortable with. And so they do have a services agreement with Penguin and Mitch that was just amended in 2020. You can actually go into the management information circular. It's on the company's website. It's also on CDAR, and check out some of the key terms of that. So here you'll see, again, just quickly, there are a lot of related party transactions going back and forth between SmartCentres and Penguin, and it includes $174 million of loans that the REIT has made to Penguin. So again, we're not going to go through everything in detail here, but just something that you want to make sure you're comfortable with. And last one on structure, again, not overly complex here, but with all of the projects that they have on the go, they have a lot of joint ventures, and some of these projects have added different LP units to the structure. So you can see here on the right-hand side of the page, you've got your trust units, 145 million, but then there's a whole boatload of different LP units that total 173 million of fully diluted units outstanding. So you just want to make sure that you take that into account. And development projects are often shared with Penguin and other developers. So again, from their investor presentation, you can see some of the key projects that they've got on the go here, and the share for SmartCentres. So most of these development projects, they do not have 100% share. In fact, many of them, it's somewhere between 25 and 50. And several of them are shared with Penguin. So just sort of another related party dealing that you want to make sure you're comfortable with. Oh, forgot about my red box highlights. Okay, next key piece is Walmart. As we alluded to earlier, Walmart is their largest tenant by far. They account for over 25% of the REIT's revenue, and they take over 40% of the square footage. So Walmart's anchor tenant in 75% of SmartCentre properties, and again, accounts for 25% of revenue. That's typical that anchor tenants pay lower rents. So one of the quick stats I put here, currently SmartCentre average rent per square foot is $15. Average excluding anchor tenants is $22 per square foot. So back of the envelope math would suggest Walmart's probably paying in the $8 to $9 per square foot range. So obviously very important tenant, but they're not able to extract the same amount of per square foot rent as they can with some of the other tenants. Another key point, so in terms of a symbiotic relationship, Walmart Canada, 30% of their stores are owned by SmartCentres. And Walmart recently this year announced a $3.5 billion CapEx investment program on stores and infrastructure to really enhance the omni capabilities and have smarter stores and improve the ease of pickup and delivery and make the stores more modern. They also at the same time increased fees to suppliers to help fund this investment, which I'm not sure if you saw the articles, but many suppliers were not too thrilled about. But that being said, for SmartCentres here, this is for the most part a positive. I mean, you need to think through what types of investments they're making. Are they moving to a smaller store format? But if you just take a quick step back and think that Walmart, who's their biggest tenant, is making a pretty major investment in their stores across Canada, that's positive. A little bit more on Walmart. Here's the retail lease expiries for SmartCentres over the next 15 years. You can see in blue Walmart and just how big of a component they are, and then other anchor tenants in orange, and then other non-anchor tenants in the light gray. And when I listened to the Q3 call, one thing that was interesting is Walmart has renewal options on these leases, which you'd expect, but no pricing increases. At least that's the guidance that management gave on the call. So while you'd expect Walmart to be stable, don't count on SmartCentres being able to increase per square feet rents for Walmart. Okay, now let's talk about the dividend or the distribution. So the company has a great chart in their investor presentation, which you're seeing here. It essentially shows that while the payout ratio has been steadily rising, the dividend is covered. Now we're going to do a little bit more analysis on the next few slides, but a couple points just to prime it. Balance sheet's in decent shape. So debt to gross book value of about 44%. They have $5.8 billion in unencumbered assets. And they also just did a $650 million debt raise at about 2%. So despite the retail headwinds, these REITs and SmartCentre in particular here are able to raise significant amounts of debt at very, very cheap interest rates. The other thing that I like on the call, management comes across as very honest about the dividend. Again, the way that they phrased it is we're not recommending a cut, or we don't foresee ourselves recommending a cut, but ultimately that's the board's decision. So a very different tone and approach than what we saw with Riocan. So let's do a little bit of analysis on the dividend and not just take the company's payout ratio as they present it. Two things I want to point out. Again, lots of numbers on the screen here, but we're going to look at year-to-date available funds and compare it to the previous 9-month period for 2019. And you can see two things that we're going to look at are the profits from these condominium sales, which again, as you can see, we had about 29 million of those this year, and we had 0 last year, and that's being counted in our AFFO. The second thing we're going to look at is sustaining CapEx, lease commissions, tenant improvements. These are the capital costs that the REIT is telling you they need on a regular basis to maintain obviously their tenants and the quality of their stores and make small improvements. You can see that there's a big difference between how much they spent last year in the 9 months year to date. Quick math, getting here to about 15 million. And then this year, which is about 7 million. Now, some of this is a bit discretionary in terms of timing. We all know that 2020 was a crazy year. It's almost over. But you don't want to extrapolate this lower sustaining CapEx number forever. So at some point, that's going to need to move up. So let's just jump to the next slide here. And I did a little bit of analysis, just some quick analysis to look at what available funds would have been like if we normalized the year-to-date results for the sustaining CapEx and the development profits. And here's what happens. So if you do that, so 2020 year-to-date AFFO of 269 million, if you take out the 29 million in development profits, and then 18 million is the run rate number I used for sustaining CapEx and tenant improvements, etc., which was the lowest total over the last 4 years. And if you make that adjustment, you come up with more normalized AFFO of 234 million, which gives you a payout ratio of 102%. So again, not crazy. 102% is not way off the charts, but it is creeping up over 100% just on the base business of renting commercial real estate to retail tenants. And again, take a quick step back here. The development profits are real. So that's real. That's real cash. That's 30 million that they didn't have. And I think it's a big part of the story here. But if you think about the sustainability of the dividend, and if you just want to peel back that layer, you do see the payout ratio is climbing a little bit higher than what management's chart would lead you to believe. And really the takeaway here is dividend coverage is likely to require development profits going forward. You know, I don't see the retail headwinds completely going away. And so we're going to need those development profits to help properly cover the dividend going forward. Okay. Development. I think this is the last key piece before we get into key considerations. So on the development side, this is how management refers to themselves and the company. We're land development people operating shopping centers. And that struck me. I wanted to include it. They don't think of themselves as sort of a pure play income producing REIT first. They think of themselves as land development folks who happen to have a nice portfolio of shopping centers that generate income. You can see on the right here that as well, their development strategy is very diverse. So they've got self-storage projects, they've got office building projects, they've got apartments, more for rentals, they've got senior housing, and they've got condos, townhouses, and hotels. So their development activities aren't just putting condo towers up on their properties. It's a lot more diverse than that. Like we said earlier, they've got 256 development projects across 94 properties, up to, and this is, you know, obviously their number, but up to 3.5 billion in potential value creation, with the REIT's share, again, knowing that they own somewhere between 25 to 50% of most of these projects, being 1.5 billion. And again, this is over many years. We had a really good comment on our Riocan video that reminded viewers just how long some of these projects can and will take. But there is, you know, per management value there. Capital needs, this development doesn't, you know, it does come with a cost. And you can, you know, I just included a few stats. You can look at the cash flow statement if you just want a sense. You can also look at the company's investor presentation. They lay out a lot of their key projects with the expected capital contribution at their share. But you can see in 2019, 255 million, year to date, 44 million, just to get a sense of the quantum of the capital needs that'll need to go into these projects before they produce profits. And then lastly, profit timing is staggered, and you can see below. So in Q3, which caused the bump in the unit price in November that we saw, some Transit City 1 and 2 condo unit closings, that's what drove 30 million in additional FFO, or about 17 cents a share or a unit. Q4, they expect additional condo closings and another 20 million in FFO, so that's really going to help in Q4. 2021, they've got some Transit City 3 condo unit closings that they're expecting. 2022, they've got another project, 2023, etc. So the timing on these is staggered. So here's one example. In their investor presentation, they've got a whole bunch. Here's one quick example of a property in Toronto. 28-acre property. You can see it's highlighted in orange here. And I love the visual because you can see there's lots of empty and unused space. And it's got a new crosstown LRT line is being built there, so new transit coming in. This is a great example of prime Toronto property with significant unused space. You see what they're planning to do with it. Phase 1, 2 condo towers, which are the 2 green ones up front here. Potential value creation is 40 million. And I think what's interesting to point out here, then you see all these other gray towers in the background. So phase 1 value creation is 40 million expected. 20-year build out could yield 250 million, and the 250 million in potential value above the current IFRS value, it is not included in what management is citing as the 3 to 3.5 billion of upside. So it's not part of the 256 projects they currently have envisioned. So again, 20 years, a very long time, but you can see that out many, many years, there could be a lot more development upside than even what management is saying today. And they're hinting at it here. So kind of 40 million in the quote unquote near term, let's talk 5 years, but significantly more over 20 if these development plans come through. So I thought that was interesting. Okay, valuation quickly here. So for SmartCentres, I think if you want to consider the development upside, which I think is an important part of the story, proper valuation really requires you to look at each asset individually, which is going to be beyond the scope of this video. More broadly, the portfolio of assets as currently shown on their financial statements show a value of 8.8 billion, plus equity accounted investments of 436 million. That gets us a net asset value per unit of $30. You can see below here from their Q3 notes to the statements, they're using a weighted average cap rate of 5.95% on the majority of their income properties. That compares to 5.45% for Riocan. And again, not perfect comparable, but a pretty close comparable. So interesting to compare the discount rates that they're using. So based on net asset value of $30 a unit and the current trading price, the unit price is currently offering or trading at 77% of NAV, if that's the number that you buy into from their financial statements. Again, as an investor here, if you're taking, the bull case, you probably think there's a lot more value there and the development upside isn't fully captured. Comparables or comparable, same slide from our Riocan video, so we won't spend too much time on it, but I think these are very close comparables, so I think it's good to do a quick side-by-side comparison. Business, very similar. Big difference here, SmartCentres has significant Walmart concentration, which can be a positive, can also be a bit of a risk. On the structure side, Riocan has a simpler structure, all else being equal, but the very limited management ownership. Here we've got more of a complex structure. We've got this agreement with Mitch, and we've got Penguin sitting on the outside, but he does own 20% plus of the units, so he's got a lot of skin in the game. So not perfect alignment, but he does own a lot of units. Redevelopment potential, again, this was me just sort of anecdotally based on my review. I think SmartCentres has higher redevelopment potential. They've got lots of open air properties, 3,500 acres, a lot of which are unbuilt. I think it sets up really well for lots of different potential opportunities. Dividend payout ratio, Riocan's cut, SmartCentres has not. So you can sort of see the dividend lower for Riocan after the cut. SmartCentres still hanging up there at 8%. Payout ratio, I left it in based on management's calculations at 90%, but you saw from our analysis that, if you strip out the development profits, it is trending up, a little bit above 100%. Leverage, very similar. Valuation, almost bang on. So the market's kind of valuing both of these on an FFO basis at exactly the same levels, 10.5 times 2020 FFO. Okay. Key considerations, and then we're going to wrap up. So strengths, clearly, lots of well-located land with development potential, and they have a team with a track record. So again, go into their investor presentation. You can see a lot more pictures like the one property that I showed you. But they've got some great land, and they've got a team that has done this, the team that's been doing this for a long time. Number two, Walmart anchors the portfolio, and it's spending money to upgrade its Canadian locations and presence. So if, think about what that looks like in 5-10 years, and maybe their footprint shrinks. But for now, it's a strong tenant, and they're investing at a time when other retail players might be retrenching. Number three, balance sheet flexibility. Again, we talked about $5 billion plus in unencumbered properties, and they're able to raise debt at 2%. So debt investors of the debt market don't seem quite as concerned as the equity investors right now in terms of the risk on the retail side, which is a great segue into the risks. Retail headwinds, no surprise here. It's been a tough backdrop, and we didn't spend a lot of time talking about the quality of the tenants in their portfolio. It's something you want to look at, but clearly there are some headwinds. Again, when we peeled off the development profits, you do see 10% year-over-year decline in rents and NOI. I don't think that those headwinds are going to go away anytime soon. Number two, impairment of retail estate value. Retail real estate value is what I meant to say. And I think that's somewhat offset by their development initiatives. So, they might have a strip mall today that's worth X, and, the market is probably putting a big discount on it, but there's a lot of different things you might be able to do with that to unlock some value. Three, market supports redevelopment. So here what I'm talking about is, there's a long time horizon on a lot of these projects, and there could be supply demand changes over that time. Like, we're in a pretty strong residential real estate market in Canada for the last several years. Does that continue? Is there a point when supply of new build condos and finally catches up and surpasses the demand? Not sure, but just something to keep in mind. And lastly, related party transactions with Penguin and Mitch. We talked about it a lot earlier in the video. I don't think it's a huge concern. It's just something you want to be aware of. I mean, as a potential investor, I don't own SmartCentres. I'd love to see Mitch and Penguin just be a part of it, just have it all. I mean, he owns over 20% of the units. Having this, separate entity outside, it's just something extra investors need to think through. It makes it a little bit more complicated, and the incentives aren't perfectly aligned. But again, the guy owns over 20% of the units, so he cares. Key drivers, valuation and the cap rates for the retail real estate. So think just the income producing properties as they are now. What are those worth? How does occupancy do post-COVID? Walmart Canada success clearly here. They're tied at the hip. Store format, square footage evolution over time, and then densification, execution, and upside. SmartCentres management's ability to execute on these 256 projects that they've got identified. I mean, it's a lot. I think the other key piece here is market's willingness to pay for that upside. Because I think if you buy into that upside today, the market clearly isn't paying for it. So you could take two views. One, the market just isn't paying for it, and they will recognize that in time, or they won't. So conclusion, SmartCentres, as management says, it's a real estate development company with a portfolio of retail assets that fund those development initiatives and dividends. So they view themselves as developers first, and sort of that traditional REIT income producing operator second. And the development activities make the financials tougher to analyze than a pure play REIT that just had income producing assets only. Headwinds in the retail sector, I think, are likely to persist. Development activities have a long time horizon, but I do think after reviewing it that strategically located land at the major intersections and at the transit points does have long-term value in my opinion. So I do think there is value here. Investors ultimately need to trust management team to execute. There's a lot of the value here you can't really see when you just look at the financial statements. You could do a property by property analysis and try and come up with an estimate of what you think the value is, but you really need to ultimately trust management, trust them to execute. Their previous track record's favorable, and Mitch does have a 20% plus stake, which provides good, if not, it's not quite perfect, alignment. Distribution should be safe for now, but comes with a caveat that there's no further significant deterioration on the retail tenant base, and that development profits continue to reasonably cover shortfalls, kind of similar to 2020. What do you think? I'd love to hear your thoughts in the comment section below. Is the dividend safe? Is the upside on the development worth the risk of coming into a story that has headwinds on their traditional tenant base? That's it for today's video. We'll be back with more content, but until then, happy investing and don't bury your head in the sand.